You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
This is the Options Industry Council's Wide World of Options. Before we start today's show, investors should know that options involve risk and are not suitable for all investors. You should not enter into an options transaction until you have read and understood the risk disclosure document, characteristics and risks of standardized options. This brochure is available by visiting www.optionseducation.org or by calling 1-888-OPTIONS. OIC makes no recommendation with respect to any financial firm. OIC does not make any warranty as to the accuracy, usefulness, timeliness, or the continued availability or existence of information created or maintained by others. Multiple leg strategies involve multiple commission charges. Opinions and strategies expressed by others are not necessarily those of OIC, nor does OIC endorse, warrant, or guarantee products, services, or information described or offered by such firms. Commissions, fees, margins, interest, and taxes have not been included in any of the examples used in this show. These costs impact the outcome of all stock and options transactions. Consult your tax advisor about any potential consequences. None of the information presented in this show should be construed as a recommendation to buy or sell a security or to provide investment advice. Welcome to the Options Industry Council's Wide World of Options. OIC was created in 1992 to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options. OIC offers a variety of resources to those interested in learning more about options, including live seminars, webcasts, and podcasts. Check out www.optionseducation.org for more information. Now here's your host, OIC's Director of Retail Education, Joe Burgoyne.
Welcome to OIC's Wide World of Options. Thanks for joining us for today's show. Let's get started with industry happenings.
It's time to get a handle on the latest developments from the world of options. It's time for Industry Happenings.
For our listeners who trade VIX and SPX options, a recent industry happening took place at the CBOE, or Chicago Board Options Exchange. In early March, CBOE launched ETH sessions. That's extended trading hour sessions in the CBOE Volatility Index, or VIX, as well as options on the SPX, the weekly SPX, and SPX end-of-the-month options. The extended trading hours start at 3 a.m. Eastern Time and run until 9:15 Eastern Time, 15 minutes before the opening bell at 9:30. That's today's quick industry happening.
It's time to break down the latest option strategies. It's time for Strategy Spotlight.
Joining us today on Strategy Spotlight is Laurie Itkin, financial advisor with Coastwise Capital Group. And Laurie's also got a coaching business called Options Lady. And, she's also the author of a really excellent book called Every Woman Should Know Her Options. Laurie, thanks so much for joining us today.
I'm so glad to be here today, Joe.
Well, as we get started, how about if you tell our listeners a little bit about yourself, how you got into this advisor business?
Well, if you'd asked me 20 years if I'd ever be a financial advisor, I would have laughed. I started investing at the age of 24 and was always a self-directed investor. And I thought, why would anyone actually need financial advice, right? It's something we do ourselves. But so I had a different career. But it wasn't until my 40s when I realized that so many people there. It's great, the growth of self-directed investing, but there will always be people who need the advice and guidance. And wouldn't it be great if I could be a financial advisor and manage money, but at the same time educate investors on the strategies, on basic personal finance, on asset allocation and diversification, and even options. And so that's what I'm doing today.
Great combination, but I really got to ask you, what motivated you to, be able to get into investing at the age of 24?
Well, my story in my book, Every Woman Should Know Her Options, I start with this story. And I was 24 years old, and my grandmother had left me a $1,600 inheritance. And most women who are 24 would definitely buy shoes or clothes. And I thought, you know what? I'd already been laid off twice. And the only way that I would ever be self-reliant and independent was to take charge of my money and grow it. And I knew that I could do that through investing if I was patient and I was smart and I educated myself. And so I put everything, which is not a good diversification strategy, but of course I know better now. But I put everything into one stock, and I kept adding to it. I just saw it grow. Every month you get a statement, and I just started on a life path of living below my means. And anytime I got extra money, I would put it in the stock market, and I built up a very diversified portfolio. And so I was able to create a level of wealth by the time I turned 40. And now I really want to educate others, in particular women, how to do that.
That's really a compelling story. I want to go back to your early years there, though. How did you teach yourself? Now, you admitted, you weren't diversified. You threw your inheritance into one stock, but over time, you did become more diversified. How did you teach yourself, or did you have mentors to help you along the way?
Well, yeah, I do have to say that I did have a good start in that I had a finance degree from the Wharton School in its undergraduate program. So I learned very early on about different asset classes, stocks, bonds, and commodities. I also learned a little bit about options. But I think I just understood. I just started reading the Wall Street Journal every day and seeing other stocks that I was interested in. And that's how I did it. At the time, there were no ETFs. And I was not a fan of mutual funds because I had to use them through my 401k. But I just understood to do individual stocks in different industries. And for my international exposure, I used the mutual funds through my 401k plan.
Good story. Before we get into options, I do want to kind of go back a little bit. You have your business, the Options Lady business. When did you start that?
3 years ago, not too long ago.
All right. And Coastwise Capital, when did you join them?
About 6 months after I started the Options Lady, because what I found, Joe, is that although there were a bunch of people who liked the coaching, I really taught them how to become their own money manager, taking my experience and helping people understand with the resources of the internet now. Trading is so easy. The free education is endless. But there were always going to be a certain percentage of people that were too busy to manage their own money, or they weren't interested. You and I know we've been in this industry a long time. You have to spend hours every week reading, talking to people, and just continually educating yourself.
Indeed you do. And the one other item I want to cover again before we get into the nuts and bolts of options. When did you write Every Woman Should Know Her Options?
So there were two primary reasons why I wrote it, actually three. The first two are that, women are increasingly becoming the breadwinners or primary breadwinners in their households, but their skills and confidence and interest in growing that money through investing still lags that of men. And I just thought that there were too many books geared towards women on broad personal finance, get out of debt, how to spend less and save more, and not enough books written for women by women on investing. So that's the number one. Number two, I was sick and tired of, of people always, when I talked about how I was an options specialist, how people just assumed it was incredibly risky and they'd run away. And, options were invented really to hedge risk, to manage risk. And I wanted that to be known. And I wanted to do it in a way that if you were going to learn about investing, I wanted a book that could be good for people who knew nothing about investing to those that had some stock investing experience and wanted to expand their knowledge. And finally, as a financial advisor, a new financial advisor, how was I going to differentiate myself? A book is the best way to get people to know your investing philosophy, to trust you, to like you, and just to get, build a relationship with you. So those are the reasons why I wrote the book.
And has the book been effective for you?
It's unbelievable, Joe, beyond my wild expectations. One of the major online brokerage firms bought 2,000 copies to send to a selected group of female clients, obviously wanting to open up their eyes to the beauty of options. And I write a lot and blog a lot, and it gets picked up. And there are blogs that are all over the world, people reading, and even today I got a huge spike in my book sales. So it's just so wonderful that people all over the world are reading this.
Outstanding. You said something about options aren't risky. I thought options were risky.
So all investing is risky. Yeah. Anyway, I just the two strategies I talk about in the book is that if you're going to take the risks to be in the stock market, why not actually learn a couple of strategies that will reduce your risk if indeed you are going to be long a stock or ETF?
Okay. Well, that's a great place to start. So, you focus on two key strategies, and after all, the segment name here is Strategy Spotlight. Why don't we start with the covered call, which I know is, near and dear to your heart. Walk me through, how you approach an investor and maybe get them comfortable, or at least how you introduce them into the idea of a covered call.
Sure. So first of all, the number one thing is if somebody is buying stock, they're really honestly usually thinking of just capital appreciation. I'm going to buy this stock and I'm going to eventually sell it at some point at a higher price. Others will think about, I can get some capital appreciation potentially and maybe some dividend income. More experienced investors will now look on a strategy, a growth strategy, and maybe a dividend strategy. But really, there are three ways to make money on a stock or ETF, because you can also earn option premium. If you're long the stock and you agree to sell it at a higher price in the future, or even at the same price in the future, you can generate immediate income. All you're doing is giving up upside potential on that capital appreciation in exchange for guaranteed income today. So at Coastwise Capital Group, we specialize in that. We look at a stock or an ETF as a way to generate three sources of profit for a client.
So let's pretend we've got XYZ stock. That's OIC's favorite stock. And oh yeah, that's our favorite. We love it.
Does it pay a dividend, Joe? What's the dividend yield?
Of course it does, 2.3%.
That sounds about average.
There are options listed on XYZ. Let's say it's a $50 stock. Walk me through how you go about the process with an investor and the benefits and risks.
Well, I love this because the options are really endless. There's so many combinations of this. But what I would typically do is somebody new to investing, let's say they already own XYZ. They bought XYZ at $40. It's now trading at $50. Maybe it took them 2 years to get up to this point. Perhaps they're concerned that the market may be staying flat or going into correction, but they don't want to sell the stock. We can sell a call option at 50 or 52.50 or 55, whatever the ratio is, and that investor will get immediate income today and then will be potentially have to sell that stock in the future. But if the stock doesn't reach that strike price, she keeps the stock and she keeps that option premium, and maybe she also earns a dividend in that time.
Okay, so a couple things there. My guess is whatever premium you take in, obviously that gives you a little bit of downside protection based on the amount of premium you took in. I see that as a benefit, but how about if the stock is higher than the strike price at expiration, do you allow the stock to get called away? Do you typically roll to another strike? How do you approach it?
Well, as a money manager, your clients are paying us to make that decision. So in many cases, we will roll if we're still bullish on the stock and the market. It just depends how you feel about the stock or the ETF or the market as a whole. But what I like to teach self-directed investors is that, there's really no wrong answer. That's what's so great about options. You're always looking at how to optimize the strategy. But if your stock gets called away, that's fine too, because if you set it up right, you've still made great capital appreciation. You've still made income from the call option, and you've probably received a dividend. I think too many investors are relying on buy and hold, which I consider sometimes to be buy and ignore. And when you are a covered call writer, it's giving you discipline. It's really forcing you to take your capital and reallocate the capital to another opportunity. So I really like the strategy. I think it keeps you an active investor.
I like that. Buy and ignore. That's good. And I'm assuming, when stock's called away, oftentimes there are tax consequences. That's all part of your advisor service, I assume, addressing that issue.
Absolutely. In fact, I'm meeting with a client tomorrow. I'll give you a great story. She uses TurboTax, and I've been doing covered calls, writing covered calls in her taxable account, and she was annoyed, because she had to, TurboTax with the call was having error messages about the cost basis of the call, and I tried to educate her. So tomorrow, when I meet with her, I'm going to suggest, hey, maybe we just do covered calls in your IRA that I'm managing, because there are tax consequences.
Indeed, and it's been quite a bull market as well. So let's see. I guess I think that's a good kind of walk through the covered call strategy. I know also you like the whole idea of selling puts. Can you talk to our listeners about that?
Love that strategy. I tell you, when I learned about this strategy, the light bulb went off and I couldn't even believe it. What I basically say to people is, a lot of people are always afraid. They're saying, oh, I like this stock, but the price is too high. The price is too high. And then it goes higher and higher and higher, and they never get the stock. And once a person thinks about using limit orders, trying to get a lower price for the stock, if they're comfortable with that concept, then you can teach them about selling a put option and say, instead of putting a limit order in, you're going to get paid to wait. I mean, when you put a limit order in, you are tying up capital. And what is your return on investment? Nada. Okay, so with a selling a put option, you're actually getting paid. And I show people when I walk them through the return scenarios. Now, of course, the stock, you may end up being put the stock or the ETF. And once that happens, the stock or ETF could go down in value. But when you think about a stock that stays flat, maybe goes down a little bit or goes up, and you think about the premium you get, I teach people how to look at what their 3-month return is or their 2-month return. We look at how to annualize it. And I tell you, it's a great strategy. If you're just not sure you like the stock, but you're not sure about its upside potential, this is a great strategy to consider.
How much, and let's go back to the $50 stock XYZ. So walk me through maybe an example of a strike that you might sell, and then also how much money does the investor need to put up for this strategy?
Well, perfect. So let's assuming we have a cash account. It's not a margin account. Okay, I like stock XYZ. It's at 50, but I'm cheap. I don't want to pay $50. I could put a limit order in. And now, Joe, in this case, let's just say the strike prices are $1 apart. I could put in, again, there's endless combinations, right? But I could put, literally not endless, but many combinations. So I could say, you know what, I'm going to sell the 49 strike, whatever time frame out I want, and I'm going to get income. The longer I go, the more income I get, but actually it may not be optimized on an annualized basis. You may want a shorter time frame. Well, I get money. If the stock goes down but never hits 49, I keep that income, and once that expiration happens, I carry on and I can reallocate the capital. But in that case, I have to know that I have to be ready to buy 100 shares of that stock at 49 bucks a share. So I'm going to have to keep $4,900 available. However, the difference is if I'd put a limit order in at 49, I'd still have to keep 4,900 available. So I'd rather get paid if I'm going to keep $4,900 available. And, I can't talk about specific returns, but, depending on the environment, you can have a better return than if you bought the stock and it only went up a little bit.
Got it. One thing for our listeners who may be a little bit new to this strategy, you said, if the stock is below 49, you may have the stock put to you. That's only at expiration, right? I mean, if there's still time left and the stock trades below 49, it's unlikely you would be put to at that point until expiration. Is that correct?
Unlikely, but it happens. You and I have been around this a long time to know it happens. You also get assigned early on covered calls.
Indeed, typically around dividend time, but
yes.
sometimes people do make mistakes.
Right, but again, there's no wrong answer. And you talk about mistakes. There's really there's never a mistake in investing. I tell people you're going to lose money. On certain trades, you will lose money. And if you don't lose money on certain trades, you're actually not doing something right, frankly, because the whole point with a diversified portfolio is you want to have different asset classes so that some things go up, some things go down, some things are flat, some things are up. That's how you're going to be a successful long-term investor.
Makes a lot of sense. Before we wrap it up, Laurie, I want to ask you a little bit about the methodology in the options trading coaching business. You want to tell our listeners a little bit about that?
Yeah, thanks. There's a lot of education out there. You can go to, huge seminars with hundreds of people. You can do one-on-one coaching. I think I provide a very affordable program. I have 3 months of coaching. It's one-on-one, either in person or usually it's through Skype or a different screen sharing service. And you open up a self-directed account. And I cannot give you investment advice, but I can actually help you when you're using the platform, help you analyze trades. So just like if you did have XYZ company and you're figuring out what to do with it, where do I sell a call option, what expiration, what strike price? I can't tell you what to sell and what not to sell, but I can help you analyze the different scenarios. And people really like it. I do coaching for total beginners and teach them about ETFs and how to look at fees and asset allocation diversification. But what I really enjoy doing is teaching people who have some stock experience but haven't yet ventured into options. I love teaching them the covered call and short put strategy.
Very good. And I'm sure one of your favorite references is optionseducation.org, right?
Yes, great. Lots of free education, Joe. Like I said, what I find, though, why people come to me for coaching is because the education is they feel overwhelmed. There's so much education out there, free and paid, that they need a Sherpa to sort of guide them through what resources are really going to be applicable to them and their personality.
Well, I've really enjoyed our conversation. Any final thoughts, Laurie, for our listeners?
Just if you're new to options, really spend some time and get to know it. There's so much great information, and I tell you, once you try options, you will never go back. You just won't.
Words to live by from Laurie Itkin. Laurie, thanks so much for joining us today, and look forward to seeing you, on the road down the road.
That's right. Thank you, Joe. And I will be at the Money Show in May in Las Vegas. So hope to meet some folks there.
Very good. Bye-bye, Laurie.
All right. Bye.
It's time to meet the movers and shakers from the world of options. It's time for Profiles and Perspectives.
Joining us on Profiles and Perspectives today, we're actually taking a trip to Europe. Joining us is my colleague, Gary Delaney, Director at the Options Industry Council in Europe. And with him today is Andy Nybo of the TAB Group. Andy is Head of Derivatives Research there. Welcome, guys.
Hi, it's nice to see you again. Joe, thanks for having me, Dan. I'm looking forward to talking with you.
Well, thanks for joining us, and let's go down that road of European option demand. I think you two really are foremost experts in that area, having worked together now for, 3 to 4 years on, I guess it's 3 different reports. Tell our listeners about this.
No, we've worked on 3 reports. Just a bit of perspective. 2011 was the last major study that Andy carried out on our behalf of the European equity options market. Then we had a sort of interim study that we worked on last year. And this year, we've been working on a full-scale update. And it's quite interesting because we're able to revisit some of the areas that we looked at 3 years ago. And the process has been relatively pain-free. It seems to be a well-honed process that Andy engages in. I think it'd be interesting for the listeners to know a little bit more about perhaps the methodology, how many firms you spoke to, Andy?
And if I may, right before we get to that, I mentioned the TAB Group. Andy, would you just speak briefly to who the TAB Group is?
Sure, thanks. So TAB Group is a research and consulting firm, and we focus on the capital markets, primarily on market structure and technology, and how that is impacting the developments across the equity markets, the listed derivatives markets, fixed income markets, and more recently, the whole OTC to listed derivatives marketplace. So we focus on that area. A smaller, very narrow focused firm that really is market structure is our forte.
Okay, very good. And then to follow up with what Gary asked. Now, this 2013 report recently released, you spoke to how many different firms and individuals with this particular report?
Sure. So this year, I guess it's probably helpful to talk a little bit about our methodology. When TAB Group does research, we actually go out and talk to the managers and the traders and the executives that are making the business decisions, the strategy decisions. So we will have, for a report of this nature, an interview-based study, we'll have a conversation with a sample of firms to get an understanding of trends and how things are changing and what firms are doing around providing access, for example, to U.S. listed options markets for European investors. This year we spoke to 27 different firms, about 31 different individuals to get a better understanding of the recent trends, looking at kind of 2011 as a benchmark study that we work with you guys on. And this year we asked a lot of the same questions for this study. We also asked new questions about kind of the changing trends and the new products investors were using and how firms were adapting to the evolving marketplace.
And Gary, you said, you and Andy have this down pretty good at this point. Talk a little bit about some of the methodology.
Okay, we put a framework in place. We do a bit of, thinking. It's always a good place to start as to what are the hot topics that we would like to cover. We put a template together so that Andy has a list to go from. And if as we are going along, if different stories emerge or a different emphasis is apparent, then we talk to each other and then adjust accordingly.
Did you find much of that in this year's report?
I wouldn't have said that the content changed a lot as we went along, but you were doing the interviews.
Sure. So, one of the things that became increasingly apparent is the rising interest and rising understanding of U.S. listed options markets for the European customer base.
Well, that's because Gary's doing such a fine job over there in Europe.
Very, very good. Am I paying you enough, Joe?
But in all seriousness, that it was very apparent that it was a lot easier having these conversations. A lot of the good work that Gary is doing over there, as well as the OIC in the U.S., is absolutely bearing fruit. One of the things we identified back in 2011 was a lack of, true understanding of the market structure in U.S. listed options markets. So, it was coming from the customer base, but also the brokers that provide access to U.S. markets realized there was a significant need for better resources to help educate the customer base about the benefits and challenges of using U.S. listed options and strategies. But there's been a lot of work done in that area. There's U.S. firms that have U.S. expats in Europe whose sole responsibility is to drive flow and drive customer demand into the products that best suit their needs. For example, one of the things we found out this year is there's rising sophistication of the user base, hedging strategies, the need to better manage risk exposures is a huge selling point for listed options.
Yeah, it is, and if you look at, say, the three themes of hedging, volatility, and overwriting. You compare the position with where we were 3 years ago, and certainly, for the directional hedging bit, 100% of people spoken to will use that as a strategy from time to time, not all the time, compared to, say, 70% 3 years ago. For premium overwriting, that percentage moved from 41% up to 62%, and volatility, and that's, I think, is the really interesting one. In 2011, 6% of the people interviewed would be looking at that, but in 2014 it was actually 62%.
That's remarkable, and that speaks right to what Andy's talking about when we talk volatility and we talk options. That's sophistication. So that's
exactly.
Absolutely, and one of the trends that we've seen, given the dislocation, shall I call, in the financial markets over the past, 8 to 10 years, the 2008 financial crisis, the global regulatory environment of increasing transparency and moving instruments to central clearing has had an impact on the strategies used by investors. They're constantly looking for better instruments to use their strategies and affect their strategies. And they're transitioning more and more from OTC instruments to listed instruments. It's not just a like-for-like exchange. They need certain requirements before they'll make that transition. Number one being liquidity, the ability to get in and out of a position. The volatility strategies that Gary just mentioned that investors are using, concurrent with that rise in interest from institutional investors has been huge growth in the listed volume of volatility products on U.S. exchanges that have grown. Since 2007, we've seen about a 50% compound annual growth rate, which is tremendous, one of the fastest growing sectors of the options market. So investors are able to get in positions where they are looking to hedge or take a directional view, but more importantly, they're able to exit those positions in times of need. So there's deep liquidity, and they're able to get out of that position, which is a huge benefit when you're looking to hedge a position. You want to be able to get in, but more importantly, you want to be able to get out.
No doubt about it. Gary, other findings or points of interest?
Well, points of interest, I think, for the retail audience are that hedge funds in Europe, they account, 2014, this year's study, they account for about 55% of the total order flow coming from Europe. And we've seen also growth in the private wealth management segment. That's up to 21%, previously 18%. Proprietary accounts come in at about 14%, investment managers about 6%, and miscellaneous, the balance of that. So it seems to me that the hedge fund figure is similar to what it was last time. But certainly we've seen growth in private wealth management, and I think there is more scope certainly in the investment manager area. But interestingly, Andy also uncovered interest from European retail users, didn't you?
Yes, absolutely, and that's
how would you define the retail user?
In Europe, very
Yes.
small at this point. But you do have an active constituency in Europe that trades different types of products in the European exchange landscape, structured notes, warrants. The European listed options markets are somewhat fragmented and liquidity is very low in those markets. But as Gary mentioned, one of the nuggets of information that came up this year was rising demand being driven by retail mom and pop investors trading in Europe. One of the
Gary, excuse me, Andy, are you making house calls, Gary?
Not yet. I suppose if we could do cloning actively, that might be interesting. But I don't think the regulators would be perhaps that happy if that were to happen.
Probably true. Sorry, Andy.
No problem. The beauty of the way we do our research, it's this interview-based process. So when we have conversations, we pick up nuggets of information that really identify future trends. And as Gary mentioned, one of the things we're really seeing a lot of is rising interest from that retail community as well as the private wealth community that are looking at U.S. markets as ways to enhance their returns through premium strategies, but also as ways to manage their risk or take directional views around the earnings event and corporate announcements. I mentioned before that you have U.S. brokers that have staff in Europe whose major responsibilities are, managing their client needs in U.S. derivatives markets. What we identified this year, it was unusual that the private wealth managers are also tending to have that go-to person that's the expert on U.S. markets and provides the resources, the execution capabilities for their distribution network of private money managers within the private wealth bank.
That's a development really since 2011 to a point?
Well, when I start hearing that from one or two different firms that I'm speaking to, it absolutely means that there's a lot going on in that space. We didn't talk to, every single private wealth bank, but when I talk to a guy that is, tells me at 9:25 a.m., 5 minutes before the market opens, that he doesn't have time to talk to me on the phone. Why am I calling him before the market open? It's pretty clear that he is dead set focused on that open of U.S. markets. And that is his, and when we had a conversation at a more appropriate time, he basically explained, listen, that's what I do. I am the market guy for U.S. markets. And he's a go-to execution consultant, execution expert that understands how to trade in U.S. markets.
Very good.
Yeah. One thing I'd like to add there is that something else that we found was that U.S. equity option markets, because of their liquidity and transparency, were being used as a surrogate, if you like, for other markets, and their efficiency made up for what they lacked in terms of precise asset match. So you might get somebody in Europe with an exposure on a European stock, and he would actually hedge that using a U.S. instrument, a U.S. equity option.
And are there particular hot pockets of business in Europe, as it relates to the U.S. options business?
Sure. So I guess there's two ways to look at that. It's one where the demand would originate from on an ongoing basis. And then the second way of looking at it, and what Gary just alluded to, is when there is a need to do a particular strategy. All of a sudden, you'll find a money manager in Finland that turns to U.S. listed options markets to hedge his emerging markets portfolio or bond portfolio. Again, it's that whole liquidity argument. They need to get in and out, and they'll go the most liquid instrument they can. But in terms of the former, where natural demand come from, it is really related to, just as in the U.S., it's correlated to the amount of U.S. equity assets under management. So in Europe, you have various regions, various cities, various financial centers where there are large pools of U.S. equity assets under management. Obviously, the UK, very big hedge fund community, investment management community. You also have Switzerland, Luxembourg, where there's high levels of asset management occurring as well. So those tend to be the regions, the areas where trading demand for access to U.S. listed options markets originate.
How about on the challenges side? Are there particular challenges that the industry faces in Europe?
I think because the market structure of the US equity option market is different. People find that perplexing.
Speak to that just a little bit, those differences.
Yeah, how long you got?
Yeah.
There are 12 US equity options exchanges, and there is a single clearinghouse, the Options Clearing Corporation, for all those 12 exchanges. Now, vanilla options are going to be fungible. That is, you can open a vanilla option on one exchange and close it on another. And that, although it sounds very simple, is actually quite a hard concept for investors to get their minds around, because they think, do I have to have a separate agreement for this exchange and that exchange? And actually the answer is no. So long as you're putting your orders through a smart order router, you know that they do the worrying about it. So actually it doesn't matter. But the European market structure is quite different. It tends to be an exchange with its own clearinghouse. So you have what they call a vertical silo model. In the US, we use the utility model. So you have a single clearinghouse clearing several exchanges. But sometimes the wealth of choice in terms of exchanges confuses European investors. And this is a conversation I have a lot.
Yeah.
Right, and I'll add to that. I mean, obviously we have with the complexity comes a lot of benefits, of course. You have 12 exchanges in the U.S. market, and they're all competing against each other to provide, the best type of execution protocols, trading protocols, the lowest fees, the most benefits to market makers who support the quote-driven marketplace. But with that comes complexity and fragmented liquidity on the front end. However, as Gary mentioned, you have the back-end OCC clearing that really enhances the liquidity and the ability to trade on one exchange, open a position on one exchange and sell it on another. We in the report we look at the various exchanges in Europe with the vertical clearing silos, as Gary mentioned, and it is such a fragmented marketplace in terms of liquidity as well as clearing. That's why the European market is more OTC and more, structured product focused, as opposed to the more listed U.S. market focus.
Right, makes sense. If we roll a little bit into, and maybe we've touched on it here a little bit, the whole idea of the macro environment in Europe going forward. I mean, we've got market structure. Maybe that's always going to be an issue. But do you see other issues out there that, retail customers should be aware of, or just that you see that may impact retail customers going forward?
Well, I suppose the single biggest thing that we've seen so far is that the euro hasn't blown up. So the crisis, if you like, has eased back a little bit. And I think to Europeans, it may seem that we've been living in one long crisis since 2008, but really it's been two crises. It's been the credit crunch, and it has been the problems surrounding the euro. But, 2008 is a while ago now. We are seeing a recovery in the European markets. And so when we looked at all this in 2011, the US was almost benefiting from what I would call a safe haven status. That has changed. The US isn't the only game in town, if you want to look at it that way. So investors are putting their money, in Europe, and we've seen, these macro trends impacting the order flow executed in the US markets.
Yeah, I mean, we absolutely. I'll add a little bit of color around that, because one of the things that, again, I can't get away from was the tremendous realization and understanding by the European investment community of where they could access liquidity. So although Gary has identified a trend that came up in our interviews is, instead of looking, UK domiciled hedge funds or European investors, looking outward, trying to find that safe haven or where the economic recovery was first taking hold, they are starting to look again at Europe as an area of growth, future growth. I think one of the things that we was very clear is, although they are maybe looking inward with their getting exposure to the various European economies, they are still looking for that liquid hedge and that liquid capability. And when you have a portfolio of global of European countries that are global in nature, managing your exposure through an index product, a macro index product, works very well, and oftentimes can enhance their income through both the upside and the downside.
Andy, we're fortunate enough to have you join us today. Before we wrap, I think we want to ask you a little bit about U.S. option trends. But before we go there, Gary, what else would you like to tell our listeners about what you see over in Europe?
I would like your listeners to know that we are sharing the pain of regulatory change. Mm-hmm. You speak to anybody in the business, and the growth areas are compliance, the back office, investment in doing things a different way. So that is a challenge for the business on both sides of the Atlantic. I think one of the other things is, one of the good things to come out of the credit crunch is an increased awareness by investors in Europe, and I think the same is true in the US, of how listed, transparent, liquid instruments can help them manage their portfolio.
Excellent. Andy, as we wrap, would you be kind enough to share some of the insights you see in terms of potential trends and growth in the U.S. options business here?
Sure. So, I follow the options markets very closely and look at the numbers, effectively on a day-to-day basis to try and understand what trends are occurring. And I remain, very bullish on the growth in U.S. listed options markets. We've had a 15% compound annual growth rate in trading volume since 2006. We're up a little bit more than 7% year to date, quarter over quarter this year versus first quarter of 2013. New product development, volatility products, the investor choice, investor selection is growing by leaps and bounds. The retail investor in the U.S. options market has never had it so good. Commissions are low or non-existent. They can get in and out of a position very easily. The technology tools they have access to rival some of the most powerful institutional trading tools on an institutional hedge fund desktop. It is really, it is a market that has evolved to such an extent that, it provides a very powerful, risk management as well as exposure tool to all types of investors, not just hedge funds or asset managers, but also down to mom and pop, retail investors that are looking to earn a little bit of extra income from a premium strategy or to manage the risk of perhaps a large holding of a stock that they may have owned for a long period of time.
Well, as a longtime specialist on the floor in Philadelphia, I think about, the tools that I didn't have as a professional on the floor versus what everybody has available now. I mean, it's pretty remarkable. So, well, thanks for that, Andy. Gary, before we wrap, you are our eyes and ears in Europe. Whatever words you'd like to finish with, we'd love to hear.
Well, I would say that education is a powerful tool. I think that if people can step back occasionally and see how their strategies are implemented in the market, I think this is a good thing. I think it's also important to consider things like the tightness of your spread, your counterparty risk, and just basic things like, do I understand the strategy? And you'd be surprised how often I have the same conversations. But the fact that we have these conversations is a healthy one, I think.
Well, with that, I just want to thank you both, Gary and Andy, for joining us here today on Profiles and Perspectives. And I hope our listeners appreciated this trip over to Europe. Thanks very much.
Thank you.
Joe, thank you very much for having me. I appreciate it.
It's time to upgrade your options toolbox with cutting-edge trading platforms, devices, and information. It's time for tools, resources, and good reads.
In today's tools, resources, and good reads, we want to start out by introducing you to an options software product that's fairly new to the market called Options Play. One of the things I really like about Options Play is how visual their information is displayed. It allows the investor to easily understand the trading ideas or strategies offered. There are really too many features to list completely here, but some of the more noteworthy ones include technical and fundamental rankings of your favorite stocks, ETFs, and indexes, profit and loss simulators, support and resistance levels, and analysis by at least 65 different technical indicators, as well as 40-plus complex option strategies that the program considers before offering you the Option Play top 3 choices. All of this information and more is analyzed together to come up with the proprietary Options Play score for each underlying chosen. That score will range from 1 to 100, 100 being the best score. One other detail I'd like about Options Play is that it tells you if a stock, index, or ETF is in a bullish, bearish, or neutral trend according to their analysis. You can find Options Play at www.optionsplay.com. They do offer a 30-day trial. Give it a try and see if this is a tool that works for you. Now, today's resource, which many of you probably have heard of, but maybe haven't tried, is Yahoo Finance. And that's found at www.yahoo.com. On the left side of the main finance page is a heading Finance Home with a list of links under it. Move the cursor over the Market Data link and another list of choices pops up. Click on Options and you are there. Options analysis tools, most active options, unusually high volume, and current open interest levels are just some of the offerings. Of course, as you scroll down, you'll find option news headlines too. So to find this, use either yahoo.com and click Finance, or go to www.finance.yahoo.com. Both approaches will get you to this useful online site. And lastly today, I want to mention John Nigerian's early book, How I Trade Options. It was written about 15 years ago. And for those of us who have traded for many years, of course, we're always trying to add to our approach and disciplines in trading, but the core of how we trade is often established in the earlier years. How I Trade Options by John Nigerian falls into that category. Consider checking it out. And thanks for joining us today on today's Tools, Resources, and Good Reads.
You've been listening to the Options Industry Council's Wide World of Options. If you have questions about anything you heard on today's show, email Joe Burgoyne at options@theocc.com. Or you can call OIC's Investor Services at 1-888-OPTIONS. Interested in connecting with OIC on social media? Like the OIC page on Facebook. Follow them on Twitter at options_edu. Or join their group on LinkedIn. Thanks for listening, and be sure to check out our next episode of The Wide World of Options.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.